Israel, Hamas retaliate, but discussed the war with Egyptian officials after having arrived in Cairo, but did not provide details. Negotiations are underway on another ceasefire and the release of more hostages held by the militant group, but the two sides are believed to have from and Charles.
The French Parliament has approved an immigration bill designed to strengthen France's ability to deport foreigners considered undesirable. The vote prompted a heated debate. The bill passed the lower house of Parliament, the National Assembly, on a vote of 349 to 186, which had previously been voted by the French Senate. News and analysis at townhall.com.
Partly cloudy tonight with a low of 54. Periods of clouds and sunshine tomorrow. Thursday, sunny and cloudy skies Friday. Showers in the morning on Friday, 70. Brief shower or two Saturday, and then thunderstorms on Sunday. With the KSEB Weather Center forecast from Howard Holden.
If you're looking to sell or buy a home and in need of the best realtors out there, look no further than the Matthews Group. Remax Legacy, Ronnie and Kathy Matthews have instilled in each and every team member their hard work and honest values and belief in this incredible organization has an average tenure of over 20 years. So it's clear that the Matthews team truly knows the Houston area market and what it takes to get a home sold quickly. They're employee-owned. They care about their clients, and they always go the extra mile to ensure that you can sell and purchase is seamless. The Matthews are the number one Remax team. Call the Matthews 281-440-7900 or see for yourself and go online at RonnieandCathy.com. They sell over 900 homes a year, and they know every inch of the buying and selling segment.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Wednesday, Hump Day. And we're just getting over the hump for Christmas. It's right around the corner. What are we supposed to do between now and the end of the year? Does anybody know? I'm just...
Absolutely nothing.
I know that's where I'm at right now. I was like, there ain't nothing going on. I'm trying to find stuff to write about, and there is like nothing going on right now. It's like...
Okay, here's a challenge for you.
Yeah.
Your next update.
Sure.
Do it as a limerick.
That's just stupid.
Well, it's a challenge.
It's a challenge.
If you got nothing to write about.
It'll take me longer to write a limerick than to figure out something to write about.
Well, that's the point.
Okay.
You wanted something to do.
No, I don't want something more to do. Anyway, shut up. Go over there. Do your thing. But anyway, yeah, Christmas right around the corner, of course, and it really is slowing down a whole lot here. Futures looking to point down a little bit this morning. Not surprising. This market's just been on a tear. We've just been talking about that lately. And, it's interesting because, everybody's now gone from just October was this market's never going to stop going down to where now this market's just never going to stop going up. And it's a very interesting change psychologically. I see this on, my Twitter feed as well. It's like, this market's insane. It's not ever going to stop going up. It is. It's just a question of time, right? It's just when we get there, and that'll be the thing. So just, manage your portfolio accordingly. Things will back up here a bit, and as is always the case, you stretch rubber band as far as you can in one direction. It's got to go back in the other direction at some point. That's just a function of time. But hey, good news is Santa Claus is getting ready to come to town, theoretically. He should show up on Monday on Wall Street, but Wall Street will be closed on Monday for the actual Christmas holiday. So it'll actually show up on Tuesday. The Santa Claus rally, technically the last 5 days of December, the first 2 days of January. So that's, everybody's very hopeful that they will get lots of presents this year on Wall Street. No coal is the plan. We'll see what happens. But again, markets come very far, very fast, and it's all good for right now. Now, economically speaking, Atlanta Fed out yesterday. Some of the data that we've seen coming in lately has been coming in a good bit stronger than expected. Atlanta Fed out yesterday. We've almost got a 3% growth rate in the economy for quarter 4. Now, this is coming off a 5.2% growth rate in quarter 3. So, very strong pickup in economic data. And this is kind of the interesting thing for the Fed. Of course, this whole market rally that we've had really since the end of October is based on this idea that the Fed's going to start cutting rates soon. And normally when the Fed's cutting rates, as we've talked about before, it's because, hey, we're trying to stave off economic weakness, whatever it is, but it's not out there, right? 5.4% growth in quarter 3, 3% growth in quarter, this is real, 3% annualized growth rates in quarter, and almost 3% growth rates in quarter 4. There's not really any sign of a big slowdown economically speaking. A lot of the economic data is still plugging along. Unemployment rate remains low. Wage growth still ticking up here a little bit. So again, doesn't seem to be any real issues right now, economically speaking, as we head into the first quarter of next year. So now here's the important thing. If you're expecting a near-term recession, this is an important point. So let's just use 3% as the number, right? So in order to get to a recession, what is technically the definition of a recession? And that is 2 negative quarters of economic growth of GDP, right? So that's kind of the rough ballpark. You need more than that to go along. You need to pick up in unemployment, some other things. But technically the kind of the benchmark test for a recession is 2 quarters, consecutive quarters of negative economic growth. Well, in order to get there, right, we've got to go from 3% growth to 0, and then you've got to go negative, right? So we've got to spend time just going from 3% to 0 before we can even start talking about a recession. So that we haven't seen happen yet, right? So that's going to take some time. So if you're expecting I'm hiding out in the bunker right now and I think a recession is going to happen like any day now, probably not, because again, you've got to go from 3% to 2% to 1% growth, get to 0, that's still not a recession, then you've got to get into negative growth for 2 quarters. So again, you got to kind of keep this in mind when you start. If you're expecting a real negative outcome in the markets, does it mean it can't happen? Of course it can, right? Of course we can have a recession next year. It's just probably not going to happen in the first quarter because again, you've got to slow that economic growth rate. You've got to get down to the bottom of the hill before you can actually start talking about a recession. We're just not there yet. So again, this is going to be frustrating if you're in the big bearish camp. But this also brings up the point, though, about what may or may not outperform next year. And of course, a lot of people right now are expecting small caps to be the leaders next year over large caps. Normally, that would be the case in an environment where you have very low interest rates that can help boost profit margins for small caps, Fed cutting rates, etc. Normally, that's where small caps tend to do a bit better than large cap stocks. However, you've got to be a little bit cautious with this. If you're a long-term investor, one thing to just pay attention to, let's just take, for example, and let's look at a 10-year chart as an example of the S&P 500, right? So let's just take a real long-term look here. So this is a long-term chart of the S&P 500, and going back to 20 years ago. So we've got the financial crisis, we've got the pandemic, and there's this nice sloping uptrend of the S&P 500. So again, not surprising that we've seen this. And so, this is when we start talking about these, kind of different things and taking a look at, say, for instance, let's look at the growth rate over the last 20 years. So over the last 20-year period, the S&P 500 is up 332%. So big number. Now, what's interesting here is that as we look at this, it's a very nice sloping uptrend here, and we're getting towards the top, setting all-time highs. That's obviously what everybody's kind of focused on right now. But if we take a same look at, say, for instance, the small cap 600, or actually, let's do this. Let's look at IWM as a better measure. So this is IWM. So IWM is kind of the Russell 2000. That's kind of a blend of small cap, mid cap, kind of captures that whole basic sector. So the S&P is up 332% over that 20-year period. The small mid-cap index is only up 263% and nowhere near an all-time high. So again, there's a very big difference in performance. Yes, small caps can, in the short term, maybe provide some outperformance here or there because of variabilities to the markets, etc. But over the long term, if you're a longer term investor, large cap investing has been the way to go over that time frame because you've vastly outpaced what small caps have generated. But importantly, and again, if we zoom in here a little bit, let's just go in over the last 5 years. And this is really kind of the important note right now. Over the last couple of weeks, right, we've heard a lot of talk about, oh man, small caps are just killing it over large caps. Yeah, that's true, right? But they haven't done anything, really, since May of 2022. We are just basically back to where we were in May of 22. So over the last year, these stocks have done nothing. And again, they're way off their all-time highs. So again, yes, we've had some really nice outperformance in small caps as of late. But if you are expecting weaker economic growth next year, right, small caps aren't where you want to be because small caps are very economically sensitive. So the bet on small caps, if you want to bet on small cap, I'm not saying don't, right? That's up to you. But if your thesis is small caps are going to outperform next year, that thesis has to be based on stronger economic growth. Because again, small mid-cap stocks are much more economically sensitive than large caps because they're smaller companies. They have less revenues. They have less profit margins. The other thing that has been a big differential in the drivers is small and mid caps don't do buybacks, right? Corporate buybacks, we had a record level of corporate buybacks over the last month, which has been contributing to this big S&P rally. Small and mid caps don't have that tailwind of buybacks like large cap stocks do. Just something to consider as you start thinking about where to allocate money. I'm not saying don't for next year. I'm just saying things to consider as you think about allocations as we go into next year. Okay, that's what you need to know before the bell this morning. When we come back from the break, we'll get into, hey, this soft landing narrative might be a little bit dangerous. Talk about that right after the break on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Nesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So part of the rally that we've been seeing over the last month and a half, really ever since the end of almost 2 months now, actually, since we get ready to wrap up the year, has been based on this thesis that the Federal Reserve is going to cut rates, and they're going to do this just right around the corner. They'll start cutting rates, and that'll be good because then that'll help soften the expected economic slowdown, right? So there's been this big, fear or thinking, right, that the economy is going to go into a recession because the Fed hiked rates. Now, look, there's plenty of evidence that is probably the case. We've had inverted yield curves. We've had the Fed hiking rates, tightening monetary policy, et cetera, so forth and so on. And historically, that has always led to a recession, right? However, this time, so far, economic data has been exceedingly strong, much stronger than you would have expected this far into a cycle of Fed rate hikes. And consumers keep just kind of spending and doing what they're doing. The economy continues to kind of chug along. And again, not at a crawling pace, right? We're almost at 3% growth for the Q4, as I said a minute ago. And part of that reason is because of all the money that's been flooded into the system, right? And that's still out there. That M2 as a percentage of GDP still remains very high. And, when people, I saw an interesting ad out or conversation out yesterday about a firm. A firm had a big day in the market yesterday as they announced expanding their base inside of Wal-Mart's. Inside of Wal-Mart. Just not plural, Wal-Mart. It's like saying the Walmart. This is what I get for trying to do two things at once.
Or Walmart.
Yeah, exactly. No, it's always funny. It's like, I'm going to go to the Walmart. And it's not the Walmart. It's just, I'm going to Walmart.
And you tell people about it on the Twitter.
Correct.
Yes.
Well, actually, it's not the Twitter anymore.
It's the X. Yeah.
Which nobody's ever going to call it the X.
No.
Ever.
Worst
it's never going to happen.
Branding ever.
Well, he's got bigger ideas. X is going to become it's basically a mega app. You'll be able to do everything on Twitter eventually. That's his ultimate goal. But that's why he changed it from Twitter. It's not going to be just a social media channel in the future. He's got bigger plans for it down the road. These kind of all-in-one calling them all-in-one apps. So they announced, though, that they're going to expand their relationship. So if you don't know what a firm is a buy now, pay later company. So I'm going to give people without money to spend that they're going to promise to pay me back over some period of time, right? That's what a firm does. But the point is we didn't really have these, these companies, these buy now, pay later companies are a relatively new invention. They've been around for a few years now, but there's been a rather large adoption of people using these as of late because they're running out of other sources of money. But that's kind of the point, right? And we've talked about this before. It's like consumers are very, very interesting because they are very creative in finding ways to get money that they want to spend money on, right? So I want to go out and shop and I don't have any money in my bank account. I'm going to go find ways to get it. And they're very creative about that. They've always been able to, roll credit cards, or in this case now do buy now, pay later programs. And, they're able to just keep bringing in forms of revenue to go spend money. Now, they're just going deeper and deeper into debt, unfortunately. And yes, there's eventually going to be a payback for that. And that's why you take, it's an interesting article out yesterday talking about Gen Xers have the biggest wealth gap of all the generations right now. The average Gen Xer has about $400,000 in savings, in net worth, right? That's including the equity in their home. And in order to retire, they need $1.1 million, right? So, that $600,000 gap's a problem. But, this is the vast majority of Americans. The vast majority of Americans have very little money in the bank. They have very little in savings. They have a lot of debt.
Yeah, they may have a house, but it's mortgaged to the hilt for the most part. So, this is what is keeping, though, the economy going. And, you kind of scratch your head and go, well, this soft landing, this economy is just rolling along. And as we talked about before, you've got to do a good bit of work to get into a recession. But, right now the Fed is saying, hey, we're this is the Wall Street's interpretation is that the Fed is done hiking rates. Jerome Powell has made the statement that, the market and yields were doing the work for the Fed. Well, that's been completely unwound. Over the last month and a half, we've had the most prolific drop in financial conditions that we've seen in recent history. So all that tightening that was being done by the market has been completely reversed. And, one thing that kind of surprised us at the last FOMC meeting was that Powell made no mention of that. And that was really what spurred asset prices even higher. It's like, oh, okay, the Fed doesn't even care about loosening financial conditions anymore. They've clearly given up their fight on inflation. And that was a very interesting point. There's been a lot of conversation, even Michael Leibowitz here on the show with me, saying, oh, the Fed can't back off their inflation fight because they'll lose all credibility. Well, they've dropped their inflation fight. They don't care. At least it doesn't seem to be the case at this point. And this is really, kind of the path. Last week, and I'm going to quote to you from an article this morning talking about this very issue. Fed Chair Jerome Powell finally pivoted, signaling the path for rates will be down rather than up in 2024, while reiterating his view the U.S. economy will perform well with unemployment staying reasonably low and inflation cooling off. Now, he didn't really pivot in his statement. Where the pivot came was in the Fed's projections for Fed funds rates going out over the next year, which showed 3 rate cuts. But the takeaway from Powell's comments last week was that the Fed can see its long fought for soft landing coming into focus. And what that is that is a slowdown in economic activity without going into a recession. So in other words, we go from 5.2% to 3% growth in quarter 4 to 2% growth in Q1. We get down to 1% growth in Q2, Q3. And then maybe, somewhere in there, you might even get down to 0.5% growth, but then you start growing again, right? The economy just slows down, doesn't go into a recession. You don't have a big spike in unemployment. Everything just kind of it's like a glide path onto the runway. It's that perfect scenario. According to the latest Global Fund Manager survey from Bank of America, the survey, which takes responses from investors collectively managing nearly $700 billion, found that 66% of folks see a soft landing as their base case. 23% of investors still see a hard landing incoming, whereby the economy crashes into a recession after the Fed's aggressive rate hike since 2022. Only 6% of investors are expecting the seemingly impossible no landing to come through. The outcome, of course, is all based on the premise that for this kind of no landing, soft landing scenario, is all based on this idea that the Fed can reverse their rate hikes and that all those rate hikes don't feed through into an economic loop where the consumer basically falls flat on their face at some point. In theory, what has been kind of the confounding issue up to this point is that the consumer is still going, right? The consumer hasn't hit that wall yet where interest rates have stopped them from doing things. The housing market slowed down. We got to over 7% on 30-year mortgage rates. The housing market slowed down, but it didn't crash, which everybody was expecting, right? we got to 5% 10-year Treasury yields, and the market didn't completely collapse under itself. Activity still continued on. We had the whole debt ceiling issue, and everything was resolved and moved on. It was no big deal. Remember all those headlines that, oh, the debt ceiling, this is going to cause us to default on our debt, and we were saying no, we're not. But that was the headlines. Didn't happen. So all these different issues over the last year that were prognosticated to be the calamity that unwound the market never occurred. But we'll come back from the break. Does that mean it won't? Right? Let's talk a little bit about 2024 and what some outcomes might be as we start looking forward into next year, and where ultimately the best place to be might be, right? Will it be small caps? Now, we'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The tipping thing is getting out of control. They are tip shaming you at checkout. To walk up the counter, you got to order your food, you got to pick up your food, you got to bus it to your table, clean your table, put everything away. And so, when you go to check out, now it says 10% tip, good, 15% better, 20% awesome.
The Real Investment Show podcast.
And I'm doing all the damn work. This is like self-checkout at the grocery store. It's like, I want some cheerleader to come out and go, woo, you did a good job.
At realinvestmentadvice.com.
I should be tipped.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791, or online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just talking about this soft landing narrative that we're all kind of focused on at the moment, because again, that's kind of the hope, right? This market is being driven by this idea that the market's going to have this nice soft landing, or the economy is. Everything's going to be fine. Earnings are going to grow, which is very interesting, right? So the expectations are we're going to have a rather significant increase in earnings next year and a soft landing in the economy. Here's the problem with that narrative. Where does economic growth come from? Right? That's consumers doing stuff in the markets, right? And the economy, right? They're going to the store and they're, going out to eat. They're doing all these type of things. So if the economy is going to slow down, that means they do less of that, right? Where do earnings come from for companies? Company like Chipotle, right? Which has all the restaurants. If people are spending less money, where do their revenues come from? And where do their earnings come from? Apple, just yesterday announced that they're going to have to suspend their watch sales over a patent issue right here at Christmas. Now, I don't know about you, but in the past, we don't buy our kids, new Apple phones for Christmas. It's generally Apple accessories for their phone, right? It's they're constantly losing their AirPods, so that's almost become a stocking stuffer now. It's just, here's your new, that and chargers. I've never seen, what is it about teenagers that they cannot keep up with their chargers? I don't get it. I've had the same charger for like 100 years. I had chargers before they were even chargers, and it's the same one. I don't lose it, right? I've got one in my kind of my bag that I take back and forth to work. I've got, I guess you can't call it a briefcase anymore. Nobody carries a briefcase, but I've got one that I leave by my bed where I charge my phone, and constantly my kids are like, I can't find my charger. What'd you do with it? I don't get it. So chargers and AirPods, whatever. I'm a Samsung guy. I'm with the other 75% of the population that has a real phone.
Truth.
I just speak the truth.
Just saying.
Just exactly. If you want to know the truth, listen to this show. But watches were a previous gift. So, but this year you can't even do that, right? Because Apple's now having to suspend their watch sales. But like I said, so if people are spending less on products because they don't have money or whatever the reason is, right? And that's what leads to your decline in economic activity. Now, I'm not saying a recession, mind you, right? We're just going to go from 3% growth to say 1%, right? Let's just do that. Just a modest decline in economic activity, 3% growth to 1% growth next year, as inflation comes down. Theoretically, this is the story. So just I won't tell you the answer, right? But in your own mind, formulate how do you grow earnings to $220 a share from $190 a share right now? How do you get from $190 to $220 in earnings per share if you have slower economic activity? Right? And this is the dichotomy of the markets. Markets are pricing out the market. So this entire rally that we've had since the end of October is it's what we call valuation expansion, right? Earnings aren't growing to keep up with the prices in the markets. We're just increasing valuation. So we're doing a multiple expansion move in the markets right now on this assumption that next year earnings are going to catch up with stock prices.
But it doesn't really make a lot of sense when you're talking about this economic soft recession, soft landing, whatever you want to call it, environment. So this is the dichotomy. So, when you start talking about, okay, so where, should I be looking to invest next year? Well, this is the problem for the small cap, mid cap story. As we were saying earlier, small caps and mid caps are very economically sensitive for a couple of reasons. One, they don't have huge profit margins in most cases. They're not like an Apple, right? Where they have just billions of dollars in revenue. They're not sitting on $170 billion in cash in their bank account where they can weather an economic slowdown without any impact to their company. As we've talked about before, more than 20% of small cap, mid caps are what we call zombie companies. They're having to issue debt just to stay alive, right? So if the economy slows down, that number just gets worse. They're very economically sensitive. They don't have a lot of excess capacity. The other thing they can't do is they don't do stock buybacks, which has been a big driver for profit margins for big companies. So if they're economically sensitive and you're betting on an economic slowdown, small cap, mid caps shouldn't be, in theory, the place to be. So what about large caps? Well, in an economic slowdown, in a disinflationary environment, you've got to gravitate towards companies that have the ability to grow earnings in a slower growth, disinflationary environment. That's technology. In fact, if you look at earnings projections for next year, that $220 a share is all in technology. Outside of the sector of technology, earnings are expected to decline really kind of across the board. So this is where it's going to be the big challenge, right? Are we going to have another year where it's technology leading the way and everything else is lagging? Or is it going to be a rotation year where these kind of out of favor sectors play catch up? Now, we've seen this before, mind you, right? We talked about this in 2021 when oil prices went negative. Everybody hated oil stocks. Remember, we had ESG back then, that whole theory about environmental social governance, and you were writing articles about what a scam it was. Well, everybody hated oil stocks back then. In 2022, they were the big winners, right? So you had a massive rotation. And that can happen, right? Healthcare is a good example. Healthcare has been really out of favor except for just one or two stocks this year. They have good earnings growth, good earnings potential, right? But it's been very out of favor. They pay dividends. So is healthcare going to have its year next year? Now, and look, we've talked about rotations before in the markets. Generally, whatever leads one year tends not to lead the next year. That's just kind of the way the cookie crumbles, so to speak. But it's not uncommon for what leads in one year to lead the next year too. Good for 1 or 2 years is not uncommon. And then you get a rotation somewhere else. But this idea of this soft landing has consequences to it. Yes, you may have a soft landing. You may actually avoid a recession. That's possible because of all this money that we have floating around the market still. But there is going to be a consequence of that if the Fed gets their wish of lower inflation. So this is where it's going to become a lot more challenging for a lot of these predictions about next year to come true. And look, we always have these predictions going to year end. This is the big, this is the big ego of Wall Street at work, is like, oh, well, next year you want to be invested in this and this and this because this is the way it's going to be. And it's always bullish, it's always optimistic. And most of the time it doesn't work out that way. However they expect it to be. Think something else tends to happen. As Bob Farrell once said, when all experts agree, something else tends to happen. Well, right now, the vast majority of experts agree that there's going to be a soft landing next year, and we'll avoid a recession, which maybe we won't. I don't know. I do know that there's a lot of liquidity in the markets. I do know there's a lot of risk in the markets, and I do know that things are overbought and extended on a lot of different fronts. I do realize that the decline in yields is going to potentially reignite inflation next year, which is going to be a problem for the Fed. That's what I'm saying. You can't really bet on these expectations that everything's just going to be fine next year. There's a lot of competing forces at play underlying the economy right now that we're going to have to just navigate next year. And so it's going to be important that we just stay nimble and that we respect what's going on in the markets for what it is and try not to get too wrapped up in these big macro views that the markets don't really pay much attention to, which is what we saw a lot this year. Okay, when we come back from the break, I want to talk about something just as we get ready to wrap up, because I heard a guy yesterday. I was getting ready to do a interview on Fox Business, and I was listening to, the people kind of, I could hear on the mic the people in front of me talking about returns and the, mutual fund returns. This particular investment's been great, and when this happens in 1 year, this is what happens over the next 12 and 24 months. I'm gonna come back when we come back from the break. I want to talk to you a little bit about the risk of that type of analysis. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Coming up January the 27th, we're having a special event. It's called Navigating the Markets in a Presidential Cycle. Greg Valliere is coming to be the keynote presentation. Adam Taggart will be there. Michael Leibowitz, myself, will be spending the morning talking about the economy, the markets, presidential election cycles, what to expect. Tickets are on sale right now. Early bird registration on the website. If you go to realinvestmentadvice.com, click on the banner at the top. Tickets are $99. We've got very limited seating at Hotel Sonesta here in Houston. You get your early bird special now. Ticket prices will go up as we get into early January. Get your tickets now on the website, realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So I wanted to talk to you a little bit about returns. And I see this quite often from people that, they email me and I go, well, what's been your returns over the last, 1, 3, 5, 10 years? Or, they talk about a mutual fund. Oh, I like this mutual fund. It's have these great 1, 3, 5 year, 10-year returns. It's very deceptive. And you want to be careful of it when you're making your decisions, because when you hear that, right, it sounds great. Over the last 10 years, this fund has, done X. And that's why there's always this disclaimer at the bottom that says past performance is no guarantee of future results. But this also goes with a lot of this market analysis that you'll see as well. It's like, well, every time the market is up, X in this month or this quarter, whatever, the next 12 months, the market's done this. Good example was this year, right? Earlier this year, markets were up, 10%, more than 10% in the first half of the year, right? And the analysis came out and said, hey, whenever the market's up this much in the first half of the year, the markets tend to be up, 12% through the rest of the year, whatever the number is, right? Well, the problem is this, and this is where you've got to be really careful with this analysis, is that analysis doesn't take into account or doesn't tell you about the drawdowns that happen in between. Good example was this year. In July, everybody's super bullish on the markets, then they give up a huge chunk of their gains by October. And what are they doing? They're selling out of the market. They're getting out. And then the market rallies through the end of the year, and sure, the statistics hold true, but they're not in it because they got out because of the sell-off. Same thing happens in a lot of this mutual fund analysis where it says, the last, 3, 5, 10-year returns are X. Well, they don't tell you about the massive drawdowns in between where probably you sold out of the market. So it's always better when you're looking at, returns of something is to look at the annual rate of return and compare that to the events that was occurring in the markets at that time. Right? So for instance, I like this particular mutual fund, whatever it is. How did it do in 2008? How did it do, if it's been around long enough, how did it do in 2001 and 2? How did it do in March of 2020? That's what you want to know, right? It doesn't matter whether or not the fund beat an index from one year to the next. Who cares? Did it make you money? Yeah. But how did it do in those down years? How much money did you lose? And the reason this is important is simply because of the fact that you're not going to hold the downturn. Everybody has the best of intentions of doing so, but I can tell you after almost 40 years of doing this now, people don't do that. As soon as there's a major part of a downturn, they're out. And then they don't get back in until way later. So those 1, 3, 5, 10-year returns are very deceptive about what's going to actually happen to your money. And if there's a major crash in between that 3-year and 5-year point or that 5-year and 10-year point, it's not going to reflect it. And here's the other thing about this. It's all about when you start investing. Good example, right? Let's just assume for a second that you pick out, let's just use an S&P index fund. I'm going to buy this S&P index fund. And I look back at the track record and it says this S&P index fund has returned, 15% a year on average over the last 10 years. And its returns over the last 3, 5, and 10 years have been this. And you go, well, how can I go wrong with that? So you buy it in January of 2008. The returns clearly suggest that this thing only goes up. It goes up 15% a year. I'm making up numbers, by the way. But it says this fund's going to go up 15% a year every year because that's been the average rate of return. So you buy it in January of 2008. How did you do over the next 5 years? When you look back over the next 5 years, what were your 3-year and 5-year returns? Was it 15% a year? Another good example, I'll just say, you looked at a fund in January of 2022 and said, over the last, 3, 5, 10 years, this fund returns, 8% a year, whatever it is. You've had two years of that fund doing nothing. Because you're basically where you are back in January 2022. So, so it's important, these measures of performance, averages, those type of things, are really dangerous when you're doing your own analysis. Throw that stuff out. That's not important. Look at how these funds actually performed from one year to the next, whether it's a mutual fund or an ETF, whatever it is. Look at how it performed from one year to the next. How did it do in good years? How did it do in bad years? And have the expectation that no fund manager ever anywhere on the planet is going to beat an index every single year. Things happen. If I'm a large cap manager and you have a year where small caps are outperforming, which happens, then I'm going to underperform that year. But there's there's a factor that you have to include in that analysis. So just looking for whatever fund is going to make you the most money is very dangerous, because you're going to buy the hot performing fund and you're going to lose a whole lot of money when the market goes against that manager at some point. So you have to have your expectations aligned with some reality. Does the fund make money when the market goes up? Yes. Okay, that's great. How does it do when the markets go down? How much time are you spending getting back to even, during a decline? See, those are the important questions as you start to do your analysis. But, looking at Morningstar ratings, here's the 1, 3, 5 year, 10-year rate of return. No, throw that out. It's terrible. Doesn't tell you anything. It tells you how it did. But when did you start? When did you buy the fund? And what happened in between that 3-year and 5-year mark? What happened between that 3-year and that 10-year mark? What happened to your money? And be realistic with yourself. Would you actually still be in the fund when it lost 50% of its money? And you know the answer. So, just something to think about. I just, that stuff just gets to me when I hear people talk about this stuff, because it's completely unrealistic and it leads to bad outcomes over time. Psychology is our investor side, our behaviors and our psychology are the biggest challenges we face as investors. And you need to have a good assessment of your own personal psychology and behaviors. If you have unrealistic expectations, you're always going to be disappointed with the markets, because they're not going to live up to your expectations. So you need to adjust your expectations for reality. So, understand that behavior, understand that psychology, and make those changes. Okay. Interesting article out this morning. I was reading this because I run into a lot of these people from time to time. And it is a new world that we live in today. There's, because of the internet, and YouTube and TikTok and, all this stuff, there's, a lot of things. It's, kind of the interesting story is like, your kid plays video games, like, son, you've got to quit playing. I told my kids this. Son, you got to quit playing video games to get out there in the real world, because you got to figure out how to make money. Well, there's a whole career in playing video games now that makes money. In fact, it's one of the highest paying jobs without a degree, is a video game streamer. Yeah, believe it or not, if you're old like me, right, there are actually people who will pay to watch other people play video games. I tried to start an online service of people watching me play solitaire, but it didn't really work. But there are actually people, that will pay your kids to watch them play video games. So if they're good at video games, I guess don't discourage them, right? There's a career that pays between $136,000 and $170,000 a year playing video games. Affiliate marketing, you see a lot of this on TikTok and other stuff, how to be an affiliate marketer. Most of it's a scam, but if you're actually good at affiliate marketing, $72,000 to $142,000 a year. If you can create content, there's actually job openings on Indeed and ZipRecruiter for content creators. So if you're actually good at creating content, there's actually job openings. There's companies that need content creators to come create content for them so they can put it on Facebook, YouTube, etc. And they can, sell their products, etc. They need followers just like everybody else. But if you're good at creating content, $115,000 to $128,000 a year. Social media manager. You need somebody to come in and manage your social media for you, help you be a little bit better. $64,000 to $113,000. And if you're good at influencing people, yes, an influencer, $65,000 to $104,000 a year to influence other people. And it's interesting because you hear a lot of, I heard a commercial the other day for iHeartRadio, the app. And they were talking about the fact that, I got to have, influencers to reach our audiences. And that's, they're paying people to go out there and be influencers. So, it's a new world we live in. Stuff that you thought was kind of stupid actually pays money. So there you go. All right, wraps up the show for today. Be back tomorrow with Michael Leibowitz. We will talk a little bit about, the Fed, the mess they've got themselves into and what that might mean for the markets next year. So have a great day. Be back here tomorrow. Be sure and get registered for the upcoming seminar, January 27th with Greg Valliere at Hotel Sonesta. Tickets are online now. Sales are going on. Tickets are selling. So don't miss out on your spot. Go by the website, realinvestmentadvice.com. Click the banner at the top. Get your tickets now. And that's coming up January 27th. All right. See you back here tomorrow.